Hello traders, Mark here. We're going to take a look at this daily chart of the Audi CAD. This type of price action that you see in this pair, this is a daily chart, very sideways, very volatile, sideways, not much direction. The reason for that is it's two commodity currencies going up against each other, but if you are understanding the environment that you're trading in, then it presents opportunities that you may not otherwise have recognized, and also it'll stop you as well if you understand that market state prior to any sort of consideration for a trade. It'll also stop you from trying to apply a certain type of technique in a really not conducive market state. So for instance, if you were to try and trade a trending type strategy in this environment, you're not going to make any money, right? Because you're going to be holding on for it to break and start really trending in a pretty and strong manner, and it's just not the way this pair is trading. However, on the other hand, if you are trying to trader in this environment, going from one end of a range to another in these very obvious structures, not expecting it to break out to new highs and lows and just trade it within these regions, then that can be a profitable strategy. So it's just about considering market state as well as obviously the manipulations and things like that. And this is also the type of market environment where manipulations are rife because levels are obvious. If you just think about an institution transacting, they're trying to buy low, sell high too, but the problem that they've got is that they can't buy where everyone else is buying, they can't sell where everyone else is selling, because those structures are obvious, and therefore there's not going to be the liquidity on the other side of the trade for them to take these big orders. But the same token, if they manipulate that location, then that pocket of liquidity is going to be there because other traders are trading it. So what I mean by that is, if you've got a imagine like the institution wants to sell off this level, and imagine it's got a massive order to fill. Everyone's selling off this level, so why don't they just pick a random point somewhere higher up, right? So say here, and just sell randomly up in this area to get a better price, and then that'll be great for them, right? The problem with that is though they'll be, and discount all of this. This is, I'm just trying to make a point. The problem with that is though no one's trading that location, right? They're trading the obvious structures, which means if they're just selling a random spot, there's no liquidity there, right? There's no money there, so they've got to do the bidding where the structures are obvious and where other traders are taking trades, because there's not going to be the liquidity in any just random placement on the chart. Yes, it would be lovely if they could get that higher price, right, for selling, and same the other side, right, lower price if they were buying. But the reality of that is, who's on the other side of is there going to be enough money to take the other side of that trade? The answer is no, because there's just a random spot on a chart. So this is why the manipulations occur around the structures, because that's where the pockets of liquidity reside. Hopefully that makes sense. So anyway, this is where you've got this well-defined level being traded loads. I won't draw all of the arrows, I'll just put a line through it and you'll be able to see it. Right, it's acted as support, resistance. I won't put them all in, you can see them, support, etc, etc. And in more recent time, even though it sort of went through there, it did start respecting it again and became support, then resistance, and then in recent trade it's very much respected the level, right? So that's important. Even if there is an area where it did breach and didn't respect it, once it starts respecting it again, especially in recent history, that's what you want to try and pay attention to. This sell-off in here, this is interesting because you haven't had price go all the way across to the range, and people would have been targeting that area to take some profits off the table. Now there'll be some you've got the level trader who sold at the level, then you've got the retracement traders, probably a 61% fib in there, and then you've got probably some breakout traders going short in here too. The question is, will there be some stops residing there from that in terms of carryover into this structure, because it didn't follow through and make them it didn't essentially hit the target? Yes, there will be. It would have been nicer if it wasn't so far across the range, because if it was early, like say imagine this whole distance, if this was in that top say 1/4, right, of this whole range, it's better because traders lose that objectivity when they first go in, and they'll hold more likely, and if it just turns straight back up against them, there's a good chance they'll look at the level and hang on, because they'll be like, well, this still could react as resistance if it comes back to that level. So you're going to get that carryover of liquidity at the level, which is a good thing. We want there to be a build up. You're definitely going to have a bit of that with the retracement traders, because they're later in the trade. If you sold off this level and your price got to here and then it starts to reverse, you might have the objectivity, the sort of the awareness to bail on that trade. And if you bail, right, if you come out of it with a little profit or near break even, your stops go with you. So that's why there's less chance of there being carryover. But if you're a seller in here on the retracement, and then price goes your way a little bit and then starts coming quite aggressively against you, there's a good chance you're still in the trade. You haven't bounced yet. And one of the reasons why that is more likely with this structure is because if you look at this move up, it's extremely strong, right? It's a big strong move up. It's a quick moving bit of price action as well. Big candles, vertical in nature. It's just literally gone against those retracement traders and those breakout traders pretty quickly, right? If they were selling in here and some type of retracement and breakout traders in there, it's gone against them quickly. So it's just building the case for that there's probably some stops residing there. Now that's helpful for sure, but the final sort of coup de grace, if you like, is the fact that you have actually some selling some entry cheese at the level, right? So boom, there you go. Price starts reacting off the level and it's having another go at it as well. So there's two lots of entry cheese going on at the level in real time, and these traders are guaranteeing that there are stops above this level now, right? And the fact that you can make a case for some of these level traders still remaining there, some of these retracement traders, breakout traders, right, being stuck in these trades and still at these still in these trades as prices back at the level, it's just adding to the fact that there's more stops there. There's a guarantee of stops there because of the entry cheese. That's always what guarantees the potential for manipulation. Doesn't mean there's going to be, but it's a very obvious, clear level for all to see. And as I say, it's been trading in a very typical manner for quite some time, so this doesn't look like a terrible scenario that's potentially unfolding. So what you'd want to see is maybe even some more entry cheese, right? All it does is serves to draw more people in, then bang, nails them on the top edge, kills the stops, because the very predictable behavior is to place the stops just above these structures. As it goes up, you get your breakout traders in, right? You know the script, pulls back, maybe a break pullback, get some more buyers in, and allows something to sell in the face of that, and then you'd probably want to target somewhere just north of this level as a potential take profit. So it's one to keep an eye on. It's not there yet, it's unfolding. The thing with trading manipulations is you've got to be patient, because by virtue of the fact traps have to set, right? Just like any type of trap in life, you've got to be patient, right? Sit in the long grass and wait for your prey, and then boom, you pounce. It's the same thing. The level has to develop. Not only does the level have to develop, but then there has to be the manipulation, and then obviously you've got to try and get in the trade. So all that takes a bit of time, especially when you're trading on the high time frames, but these trades pay big when they play out. So we're talking hundreds of pips, not trying to get the odd 20 pips here and there. So you've got to remain patient, but you know, I have no problem doing that. It's a skill you've got to develop, unless you're trying to be active. But hyperactive trading or active trading is extremely difficult, and most people fail at it. The brokers want you to do that. It serves them well. When you come out the compressions, it levels the playing field and makes it easier for you to over the mid to long term to make money. And that's all it's about, right? I couldn't care less about being active. I'm here to make money, and I would suggest you maybe consider that as well. Okay guys, take care.